beef. Pause. But yeah, so these two finance guys, we got Sasha and Chicken. They got into a little something, a disagreement. It was interesting because I watched what's his name? Chicken Dinner. I don't know what his nickname is. I watched the video, and then Sasha, who has been saying silent on this guy, came out and made a video. Chicken Genius, that's his name. So we're gonna roll a clip and we'll see.
YouTuber called Chicken Genius Singapore released a video that offers some incredibly stupid and very dangerous advice. And I
first 10 seconds taking shots. Very stupid advice.
Watched the video and was really taken aback because Chicken Genius seems to be universally admired on YouTube. Everyone seems to love him, his fans adore him, and he has built up this persona that people seem to really take to. He is an honest guy, you see, who shares killer trading tips, and 2 months ago he quit YouTube.
With all my heart, this is my last piece of advice. Don't trust easily. Most people fall for the trap of a good salesman.
He made a whole video about quitting YouTube, and I think I was about the only finance YouTuber who didn't make a sad reaction video. Now, I don't have anything against Ken personally. I also do not have anything...
I don't think I made one either. And you see, yeah, no one probably would have watched it anyway, so...
against what Ken chooses to do with his own money. If he wants to play the options game, any other kind of gambling, that is completely up to him. I do not care one iota what anyone does with their own money. But I do have a problem with extremely bad, direct, specific financial advice being dished out to people on YouTube. And this video yesterday comes on the back of a few short videos marking the miraculous return of Ken after he quit. I try my best not to get involved in YouTube drama as much as possible, and I make very few videos like this, but unfortunately have to is what Ken said in his video yesterday.
Buy the dip. For every $1 the central banks injected, the stock market went up $1. If the Fed removes $1, the stock market drops $1.
Unfortunately, this point is complete and utter bullshit and has absolutely no substance whatsoever.
I was thinking the same thing when he said it, because I was just like, if it was that simple to read the stock market, well, everybody would be rich, because whenever they took money out, you know what I mean? Like, it didn't make sense to me, but I just moved on with my life.
I will show you the numbers in a second, but let me play a bit more of Chicken Genius's video first.
This is the Fed balance sheet. Notice it has been going up since 08-09 crash, and the stock market goes up accordingly. The central banks control money supply, and right now, the Fed plans to remove $2 trillion. This means the stock market will drop a lot.
So the argument here is that the level of the Fed's balance sheet increased since 2008, and the stock market also went up since 2008. So the two must be correlated, and there must be a causal relationship. Unfortunately, this is a very common mistake in statistics made by people who don't understand statistics. Just because two things have a similar trend means absolutely nothing for one causing the other, or there being any kind of correlation whatsoever. The first problem here is that if you actually do overlay the two charts, you can very quickly see there is extremely poor actual correlation, other than the fact that both of them kind of go up. Here I've overlaid the two charts with the y-axis intentionally skewed to make them line up artificially, because that's how you do analysis. The stock market actually went down in 2008 when the balance sheet started increasing, and the stock market then had a big wobble in 2011 when there was no movement in the balance sheet whatsoever, and the stock market actually dropped in 2018 and in 2020 without the balance sheet going down for whatever strange reason. And in 2018, the Fed already ran a smaller quantitative tightening program, and guess what? The stock market went up. How bizarre.
So yeah, basically, it's weird. See, this is why I don't try to act like I'm an expert on here, because, you know, I mean, obviously everybody's always constantly learning, but when these guys come out and they try to act like experts, and it's so easy for people to just be like, nah, that doesn't make any sense. Because in my personal opinion, no one, and that's why I hate when I see people on YouTube, they pull up their charts and stuff like that. Because if it was that easy to predict what the stock market was going to do, they would be billionaires, and they're not. So,
The Fed balance sheet is a very important macroeconomic variable that affects many things, but the effects are much more sophisticated than this junk piece of analysis. Oh, and you can see on his own chart that the balance sheet went up by about $8 trillion since 2008, and he's comparing it to the S&P 500, so let's go and compare it to the S&P 500, which has gone up by $33 billion roughly in the same time frame. So I'm not sure exactly what it is that he does in terms of maths here, but there is definitely no $1 for $1 relationship whatsoever. I mean, it makes absolutely zero sense anyway, logically, but it doesn't even match what he's saying. Because according to this theory, the stock market only goes up and down with increases or decreases in the balance sheet, and nothing else really matters. It's $1 added to the balance sheet, therefore the market goes up by $1. So according to this stupid argument, there is absolutely zero productivity or any kind of organic growth in terms of overall market at all, which means you might as well stop investing in the stock market altogether, which incredibly is exactly what Ken decides to say in this video.
Do not fight the central banks, and until they stop removing money, or the rumor that they will stop removing money to slow inflation, do not buy the dip.
I mean, it is not surprising because he has been saying the same thing a lot recently, and this is a massive problem because there are no ifs, no buts. We have a finance YouTuber giving very exact, very specific, direct investing advice. No qualifying statements or considerations or kind of pieces of thought there, just plain instructions to not invest in the stock market. And I just showed you that the reason being given is a giant pile of horseshit. Ken has exactly zero idea where the stock market is going. Just like I have no idea where the stock market is going, and just like you don't either. Nobody does.
The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had.
But there is this culture on YouTube of pretending that you are the messiah who knows, because...
And that's what I hate. I really do hate that they do that. Like, and then they get people all, oh, yeah, it's going to do this, and it doesn't, and it drops, or it goes up, and you missed your opportunity because you didn't, quote unquote, buy the dip. That's why I wouldn't sit up there and honestly tell people what they should do. I would tell them what I'm doing, and if I lose money, I lose money. If I gain money, I make money, I make money. But, like a lot of these guys, they're like not giving out financial advice, but your audience is kind of taking it as financial advice.
You have shown that one graph went up and another graph went up, therefore proof. I just went onto the website of the US Department of Agriculture and got some incredible data. Check this out. Here is a nifty table for the per capita consumption of cheese in the United States since 1995. And if you look very closely at mozzarella, you will notice an incredible trend. I plotted this chart of how much mozzarella people eat in the United States, and the very concerning thing is that it seems to be even more predictive of the S&P 500 than the Fed's balance sheet. And there has been a worrying recent trend of people eating less pizza because it is, not all that healthy. So I guess we should definitely not invest in the stock market until pizza is back in fashion and people start eating more mozzarella again. But wait, the problem here is actually a lot worse. It's not just tied to this video, because I am sure there will be armies of Ken's fans leaving colorful comments below this video telling me that I am a donkey or something worse, because that is what Ken likes to call other YouTubers, because he is the righteous one and everyone else is an idiot. But I am guessing many of these fans don't really know much about Ken's background, because Ken makes a song and dance in his videos about being a successful entrepreneur, and therefore his views on investing carry far more weight than everyone else's. After all, he is not here for the YouTube algorithm. He is not here to make money on YouTube. He is not a grifter like every other finance YouTuber. He doesn't try and sell people ridiculous courses with spurious claims, except that is exactly how Ken has made his money. That is how he does entrepreneurship. He has sold courses on trading options under many different brands. Just go on Google and type in Ken 10 course, and here is the #1 result. Learn how you can easily and safely generate 2 to 3% or more of passive income with as little time as 15 minutes per month. How handy. Here it says, Hi there, I'm Ken Tang, the co-founder of this course, an entrepreneur, owner of businesses, property, blah, blah, blah. Trust me. A typical, very, very typical sales pitch. He is financially independent, retired early, and you know what? Making a giant load of money just like him is super easy. It just takes 15 minutes a month and you can get returns of 2 to 3% per month, which is way, way more than the stock market. It is just so easy. By the way, this kind of advert would actually be illegal in the UK, in the United States, because promising high returns of investing and saying it is easy and safe literally is fucking moronic.
And it's so interesting because a lot of gurus, and that's the thing that sucks about, like, as you grow and you become more of a professional in your field, to where, like, maybe you did decide that you wanted to sell a course or something like that. Courses are looked down upon so much, like courses and all this other stuff, because so many people try to scam, and it's like really sad, because the thing about it is there are legit people out there that can really, you know, take you to the next level. But even myself, I do a ton of, I've only worked with like 2 people, and I've probably bought 2 courses in my life, and none of them were in the hundreds of dollars. They were like $20 and $50. But the thing, I mean, it is what it is, because most of these guys, I remember the first guy it's about 10 years ago, a guy named Tim Sykes. When I started penny stock investing, he was all over. He's pretty famous. I'm probably going to do a reaction to one of his old videos. I found it. But I ended up going on YouTube and finding out the information myself. But he was selling courses, and you couldn't imagine, like, if he was so rich, why are you selling courses and dealing with customers? If I'm making a ton of money on the stock market, I don't want to deal with customers. I'm already rich. I got the clout. I'm good. Like, life's going to go on.
I am not up to speed with what the laws are over in Singapore. Maybe they are more lax, but this is disgusting. And unfortunately, I don't know exactly how much this course was because it is not available now, but it has all the classic fake guru click funnel elements. Go and watch this little introductory video, then I'm going to go and sell you into the course. It is super easy, it is quick, you don't have to be financially savvy. Trading options is really easy to understand. It's just a simple 4-step system. It is also safer compared to other options and investing strategies, and yet there is no risk whatsoever. You make money if stocks go up, you also make money if stocks go sideways, you make money if stocks go down, you make money whatever happens. What is not to like? This is the disgusting grift that Ken used to earn his money. So when you see his portfolio that has some number of zeros, those zeros didn't come from some kind of genius investing moves over the long term. It appears that at least a fair chunk of it came from selling disgusting get-rich-quick courses through shilling extremely high-risk investing strategies. In countries like the US and UK, it is illegal to offer options trading to unsophisticated investors. There are literal laws, and this is why you would have to self-certify yourself as a professional investor, and you might have to show evidence in order to be able to trade options on most platforms. And the reason for it is because it is high risk. Yeah, high risk, not no risk. It is not easy, and it loses a secret sauce strategy that is. The BS numbers just don't stack up.
I'm going to skip around a little bit because I saw this video already, and I got to go
Educational course.
get my hair cut. I'm looking a little rough.
On YouTube, whether I think they're good value or not. I don't have any issue with what people choose
Because he had a part 2, so I'm assuming Chicken Genius clapped back, and he's going to respond to
to do
that.
with their own money. I do have a problem, though, with people pretending that they are some kind of fucking oracle when the
Yeah,
truth is
me
that
too.
he is completely gave and say that he is the true messiah because he apparently sold all of his positions back in January or December and shorted the market. He is absolutely perfect, except here is the video from his channel from the end of January where he gives some tips on what to do in this market crash.
And selling now just means one thing. And I'm willing to take that bet. The people who sell, their returns as an investor has historically underperformed indexes over the long term.
And a week later, at the end of February, he was absolutely confident there was going to be a sharp V-shaped recovery. Look, there's evidence. He drew some random line which proves that that was the absolute bottom.
I've predicted in a previous video, I drew this V shape. And so far, so good.
I hate when, well, let me not say bruh, ladies and gentlemen, I hate when people do this. I hate when they pull up, when I see people, and there's been creators on YouTube that I was getting ready to subscribe to, and then they pull up this dumbass chart, and I'm just like, fuck you. Like, I hate it. I remember maybe it was a video on YouTube or it was a rich guy I was talking to. I don't remember. I talk to a lot of people. Obviously, you can see I like to talk. And basically, I think it was a video. Basically, the guy said, you know, if you look on a chart and it goes from the left and it goes up to the right, it's probably going to continue to go up. If you look at the chart and it starts up here and it goes down, it's probably going to continue to go down. No one knows what this is. Remember in 2020 when this demic first started and it dropped like that? I'm not going to lie. I didn't buy anything when I saw it do that. And who was to know that it was going to do a whole V shape and keep going? Who knew that the, you know, feds and everybody was going to pump so much money into the market? Nobody knew this. I don't even think they knew that until the Rona situation happened.
And here is why I'm confident this will happen.
I really, really hate grifters who draw some random lines on a chart pretending that they mean anything because technical analysis, bro. And then in March, he was also still strongly advocating that people go and buy the dip because cash is trash, etc., etc.
Inflation is an invisible tax
Yeah,
on
nice
the
setup,
society. Because simply cash is trash. Your buying power shrinks. The only solution.
Listen, I've lost some money, some serious money in this crypto situation. And I mean, most of it was like, I want to say probably 50% of it was profits because I don't plan on selling stuff. I just plan to continue to keep buying. But if I could go back to January and sell it and have the cash, then I'd be able to buy so much more right now. So you really can't really say cash is trash either. But obviously it is trash because it's getting destroyed by inflation. But you know what's getting destroyed? A lot of people's portfolios.
Buy cash-generating assets like stocks or real estate that's proven over time. Don't worry about everyday price movement. A year from now, you will be looking back and telling the next generation of investors like a war veteran.
And this is after the war started, the market fell even more. We already had oil at $120 a barrel, and apparently it was 2 months after he had decided to sell everything and absolutely perfectly time the market. And now that the market overall is down 20%, now, compared to all those other months, you definitely should not be investing because now the technical analysis you see shows the exact opposite for whatever reason. Maybe because it is absolutely full of shit and is made up to suit whatever narrative it is that you want to peddle.
Okay. I got about 20 more minutes left, so I want to skip to the next one and see.
Hey guys,
I saw that one. It wasn't.
Sasha, a big problem with donkeys is that they are stubborn. You point out that a donkey made a mistake, and instead of taking the L, they go and double down on the dumb thing that they said in the first place. So yesterday, the chicken man responded to a video I made, and in that video, he decided to just repeat.
Wait. I give $5 to anybody who knows who that is. Let me not say $5 because all of y'all Google it. Damn, what that was?
Place. So yesterday, the chicken.
Who was that? In the chat? All 3 of y'all, 4 of y'all? That's my guy.
Chicken man responded to a video I made, and in that video, he decided to just repeat the same exact points to prove his
Breaking Bad. That's the show. And he was the chicken
thesis. Ken, the inventor of absolutely risk-free options trading that makes you a guaranteed billionaire without having to do any work, said this.
Look at this chart. I'll leave it here and the big version of it is on my Twitter. I'll link it below.
It's very kind of him to provide the detailed chart that accurately points out the exact opposite of what he thinks he was trying to prove. Apparently, taking any two charts that go up and lining up the bottom and the top proves correlation and causation. But let's assume for just a second that these two variables are specifically indirectly correlated and have a causal relationship. The point Chicken Genius made in his video is that when the US balance sheet goes down, it automatically causes the stock market to go down at the same time. That was the entire thesis for his video, where he instructed everyone to categorically not buy into the an even bigger hole.
When you have a 2 trillion sell order, do you think the stock will go down 2 trillion? To imagine someone to think, yes, It's as dumb as a donkey.
So unfortunately, it appears that he doesn't understand how quantitative tightening works or what the effects are. There is no sell order placed on the US stock market directly or indirectly. In fact, the US Federal Reserve's quantitative easing program over the last 2 years did not buy stocks. The purchases were limited to bonds, bond-based securities, and mortgage-backed securities. Now that the balance sheet is going to start reducing, the policy announced at the Fed meeting last week does not even include the sales of any assets full stop. This is really critical to understand, and most people are aware, except for people who aren't. The strategy is only waiting for the existing assets held on the balance sheet to mature and then write them off. So the treasuries that the Fed owns reach their maturity, and the Fed then pays those back to themselves and effectively deletes the money from the system. This is how the Fed's balance sheet is going to reduce, according to their own plan. As the Fed will not replace these with new treasuries, there will be a reduction in the number of the total treasuries available in total, although this reduction will be a paper reduction. Since the Fed bought them from the market already, they were not in circulation or affecting the natural demand-supply equation up to this point after they were repurchased. They were off the market. There will be some long-term implications of the fact that no new bonds are being issued to replace those expiring ones, because they will reduce supply in total, and as we have high inflation and as the rates are going up, that will stimulate bond yields. I do get that point. This will take some time to filter through though. This is really critical to understand. And if the inflation situation and the market moves in the interim during that period, the effect may be very hard to see relative to the overall picture. For any donkeys in the back, the Fed is not selling any stocks. There are no sell orders being placed. And I know, he probably didn't mean it literally, because as the money is taken off the table, there is less liquidity in the market. But here is what the Fed balance sheet is made up of. This data is from June 16th, very recent, and out of the $8.9 trillion sitting on the balance sheet, $5.8 trillion is in US treasuries, and another $2.7 trillion is in mortgage-backed securities, and the rest is relatively nominal. In the May press release, the Fed announced that they will be reducing their treasuries balance by $30 billion per month for the first 3 months of the program, that's June, July, and August, and then after that, they will start to increase that reduction to $60 billion per month, and the current expectation is that it will remain at that $60 billion per month to the end of 2023. For context, the Fed was purchasing $80 billion per month from March 2020 through to March 2022. So this level of reduction is already going to be considerably slower, but because the Fed is not doing active quantitative tightening, the effect is not the exact opposite of quantitative easing. During quantitative easing, money was thrown straight into the bank accounts of the banks whose securities, bonds, etc. were being purchased, and that found its way into the economy from there relatively quickly and relatively directly. In this quantitative tightening, no money is moving anywhere. The Fed is burning the government bonds when they expire. There will be an element of reducing the mortgage-backed securities pile, but that is going to be a relatively small part of the overall program, apparently. I know that there will be a lot of Chicken Genius fans watching because you all showed up to the last video, and I want to address a very popular argument that I saw in the comments. What if Chicken Genius is right? What if the market does go down and the Messiah's prophecy comes true? Will I bow down before the oracle and concede defeat because he was right and I was wrong? Well, you see, the thing is, I don't actually pretend that I know which way the market is going to go.
Right. Smart man.
I'm not here to tell you that it's definitely going to go one way or definitely going to go another, because I actually understand that I don't know. And neither does anybody else. I am not saying that I think the market is going to go into a sharp V-shaped recovery. No, that is actually what the Chicken Man was saying back in February and in March.
I've predicted in a previous video, I drew this V shape. And so far, so good. And here is why I'm confident this will happen.
Time out. Why does he have this Rode mic on a fork? I would pull up the thing. There's a $10 thing you can buy so you can insert this that I own. Making too much money to be using a fork, bro.
The guy who is always perfectly right was telling you this is exactly what's going to happen. So here is a chart of the S&P 500. And in January, he was saying that you should definitely be buying. I showed these clips in the last video. And in February, he was still saying that you should definitely buy. And in March, he was also saying that you should buy even after the war has started. But now that the market is down by over 20%, now he is saying that you should not buy and instead Fed short the market, now you should be holding cash instead. So I guess the all-seeing oracle didn't see quite everything, and maybe he is a bit of a fan of a buy high and sell low investing strategy, or at least he makes content based on which way the wind is blowing that day. So when the market goes up, make content about buying everything, and when the market is down, make content about selling everything.
And you know what's so annoying about that? Because I don't think they're really saying anything else. I'm gonna go to Tom's video next because I got like another 7 minutes before I gotta go and get this rug cut off my head. So I'm looking like a little rough bucket. But the thing that I hate about it is because I don't know if you follow someone religiously, like, you know, like how I am with financial education. Damn, I hate when it does that. I'm gonna get a new camera. But how I am with Jeremy from Financial Education Channel. But I don't forget that you told me to buy the dip and then you turn around and you change your mind and now you're saying like, oh, like if you're saying it's gonna go up to not buy or to buy, and then a month later you say, who was a good person that did that? We talked about him. All right, whatever, I'll move on. I can't. Meet Kevin did that and everybody flipped out. Like, I'm not gonna forget these things, so I don't know why they even do it. Like, I would just stick to one thing, one strategy. And you know, if I change my mind, you know, I just don't know how you play that off. Like, because no one knows everything, so don't try to act like you're an expert. Like,
It makes perfect sense. He has absolutely
Jeremy from Financial Education is probably the one I'd say I trust the most out of all of these guys on the internet when it comes to his advice, and he's lost me money too. So, you know. But he doesn't try to come off as an expert, so it's a little bit more genuine. Like, you can tell he does his research, and from that, you know, he goes from there.
absolutely no idea where the market bottom was going to be.
Okay,
Neither
let's
do
skip
I.
around. We'll skip around a little bit and see if he's just talking. What's this?
Sort of maybe line up proves absolutely nothing. And here is the funny thing. I kind of agree with Chicken Genius that the outlook for the stock market is not great. I said as much in some
Yeah, I think it's gonna go down too. All right, let me see.
financial advisor. Ken is a guy who hates people who sell investing courses on YouTube. How dare they?
All right, he talked about this. So Tom Nash, who I rock with as well, he came out with a little video. We got about 5 minutes left before I run out of here. So I'm gonna run this clip real quick and then we'll see.
Okay, let's talk about YouTube drama. More specifically, financial YouTube drama. Can't believe I'm saying this shit. More specifically, chicken, and I think why we're making names were thrown into the air, such as scammer, fraudster, donkey, whatever. But the reason I'm making this video is the same reason I texted Sasha yesterday, saying, hey, dude, I think you guys need to work it out. I think you need to find the middle ground.
Oh, that's so
Since I'm seeing
cute.
that's not happening, where they get 5 videos between the two of them slugging mud at each other, I think this video should serve as the catalyst to finishing this beef and just moving forward.
Come on,
So I'm
Tom.
gonna be the referee here.
It's
and I'm gonna
entertaining.
end it today. And here's my verdict. So I think Sasha and Ken, Chicken Genius, are kind of like a divorced couple. You ever heard a divorced couple argue? That sort of argument has 0% chance of ever getting to a point where they agree on anything. It's emotionally impossible for them to agree. And I think the reason is because they're trying basically here to debate, Ken and Sasha, what tastes better, oranges or apples. Who the fuck knows? But each of them...
I don't agree with that, Tom. I think one is saying you're a scammer, and I'm agreeing with Sasha. The other one is making up stuff, and Sasha's showing like the holes in his argument. And the best way to combat somebody showing holes in your argument is to provide the evidence that you have. And being that this Chicken Genius guy, I believe, made it up, just like all these guys on the internet that, you know, they show up their charts and they start talking about these patterns and bullshit, then he doesn't really have any evidence. So yeah, I don't know if it's apples and oranges.
have a good point. If you like apples, you think apples taste better. If you like oranges, you think oranges taste better. And there is a scenario where both of them are right. I'll explain what I mean.
Yeah.
On the one hand, you have Ken, Chicken Genius, saying, hey, the Fed is effectively sucking all the money from the market. and that's going to crash the stock market. That's why
Must
I'm
be
not buying the dip.
time up a little bit. So
On
I
the
can
other hand,
finish
you have
this.
Sasha saying, hey, I think your specific advice as far as not buying the dip and staying in cash is an attempt to time the market. And timing the market is something nobody has the skill set to do. Not even Warren Buffett, not me, not you, not Tom Nash, not anybody. Especially not Tom Nash. Palantir, anybody? So timing the market is a dumbass idea. So Sasha is saying that, hey, your advice is trash, not because of your analysis. Sasha actually admits that his analysis is on point, but because he's effectively trying to time the market and encouraging others to do so. And he says that that's really not cool. Now, here's me coming in as the referee here. Ken is an options guy, primarily an options guy. Sasha is a long-term classic investor. He doesn't do any day trading, any swing trading, long-term, unfazed by price swings, unfazed by drama, long-term. So for a long-term investor, timing the market makes absolutely zero sense. Why? But for an options guy like Ken, timing the market is literally what he does for a living. Now, Ken has a long-term investment portfolio in Tesla, yes, but his bread and butter is options. Options traders literally try to time the market. Now, whether they're successful or not, I don't know. But the advice here is basically coming from an options trader about timing the market. That's literally what he does. And then the long-term investor is listening to this saying, oh, that's a bad advice. When you have two people arguing about a topic coming from completely different methodologies, both of them can be right. And in this case, both of them are right. Ken is right in saying, hey, if you're an options trader, timing the market right now with the Fed basically driving a pile driver through the market might not be such a bad idea. For options traders, for day traders, for swing traders, yes. For long-term investors, DCAing, dollar cost averaging into good companies in weakness is a proven strategy, and everything else is just bullshit. So both of them are right. And if they had the chance to actually talk about it without this ad hominem attacks at each other, the donkey and the scammer, then they would agree. And that's what
I disagree with that as well, and I'm gonna tell you why.
I think.
Yeah, I disagree with that is because the person that's right is the person that is long term gonna make more money. So if option traders were making more money, then we could say that, yeah, their strategy is the better one. It's the right strategy to go by. But studies have shown, like, when people do all of this trading, not only is your taxes, do you pay more in taxes if you making short-term gains, but you also, like, when it comes to traders, I want to say it's maybe it's probably no more than 5% of traders that are really profitable. The other people, terrible. But if you put your money into the stock market and you leave it there, long term, you're going to do better than these traders. So in my opinion, you can't really, that strategy, the long-term strategy is the right one.
So my main goal is to use this video to get them to agree, because both of them are right. Now,
No,
did Sasha exaggerate a
you're
little
not
bit to
gonna
get a little
agree.
bit more pizzazz and drama, to get more views of this? For sure. For sure. He's probably about 60%, 70% of what he's actually showing is what he's feeling. There's obviously exaggeration, but I do the same thing. Every creator on YouTube does the same thing. I cannot hold it against him. We all exaggerate for views. It's just how the platform works. So no issues there at all. Now, final point. As far as the strength of the debate here, the strength of the debate purely on an academic level, Sasha has a better position, because Sasha is saying, look,
Right.
no matter what happens with the market can go up, can go down, might be right, might be wrong. I'm still going to be right in this debate, because I said that you cannot time the market. That's the only thing I'm saying. So whatever happens in the market does not take away from my debate, which is a kind of a long-standing fact in the stock market.
Okay, that's it. It's 3:40 over here, and I gotta get this rug cut off my head, like I said, so the waves can spin. That's all I got for y'all. Hit the like, comment, share, subscribe, and I holla.
Brim low on my fitted, dreams has always been vivid.